Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week, of the market's key events and trading opportunities. So I'll just let you have a look at a couple of disclaimers I need to show you. I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Our goal during these webinars is to break down all the market jargon and complexities that you read about. So if you do have any questions, please do ask them along the way and write them in the box, and I will hope to answer them as soon as possible, or at least after the webinar finishes. I'll just run through what we hope to get through in the next half hour, 40 minutes or so. We'll just check out how markets are trading currently. We'll also have a brief look at the Magnificent Seven, just highlighting some charts that we have on those stocks. Before then, just quickly looking at the technicals around the US major indices. We'll then just quickly review last week's main events, some big events which have driven really markets going forward. So US CPI data and of course the Fed meeting from last week. We'll have a few charts on those before then looking at this week's main events. So the RBA meeting we had on Tuesday, we had UK CPI data out this morning in the UK. We have the Bank of England meeting tomorrow, and then we also have the S&P meeting, which I'll just highlight briefly, as well as PMI data as well. Okay, markets currently, just checking really, it's really the AI rally that continues to dominate at least US stock indices. Nvidia, of course, became the most valuable stock in the world. That was really the big news from yesterday. Overtook Microsoft as the most valuable company on the planet, 7.3% weighting now in the S&P 500, market value of $3.34 trillion, I think. Yeah, we'll look at that briefly shortly. Hong Kong equities there up quite nicely in the green on expectations of financial market reforms, while futures are indicating, yeah, better opens in the US and Europe. It is a holiday in the US, so the cash market will be closed, though futures will be open, as well as the FX market, of course, today, but there will be much thinner liquidity after the European session closes. Currencies just marginally weaker. Dollar at the moment, and it came on the back of the negative US retail sales out yesterday. But a small range really, Fed officials advocating patience with rate cuts. Aussie has been stronger, basically on the hawkish RBA comments. We'll look at that in more detail shortly, but the board really more alert to upside inflation risks and appear less certain that inflation is moderating or is moderating as they would like, with lingering concerns really about persistent price pressures. Crude oil remains in a little bit of an uptrend really, markets eyeing the summer driving season in the US and increased demand. Gold is yo-yoing really, that continues this week. Interesting, the Gold Council survey showed that 29% of central banks plan to increase reserves, which is the highest since the survey began in 2018. I'm just pulling up some charts first of all, just to show you guys. We have the S&P here. Otherwise markets, sorry, just checking out where markets are. Fixed income markets and bond markets, US yields have dipped, and they did dip again on the negative surprise, as I said, in those US retail sales numbers yesterday. Nothing too concerning, some revisions, but just highlighting the potential for consumer activity to possibly slow. That's been the main engine of growth in the US economy for sure, so something to watch out for. Interesting that the closing level on the 10-year US Treasury, if I just pull up that chart first of all, which you can see here, is, yeah, here's the 10-year, and we're just sort of closing in, well, just falling towards the 4% level now, which is a key psychological level, was sort of 4.21 or so. So that's the US 10-year yield. As for stocks, they obviously continue to make record highs, keep on writing about it, reading about it. I think it was the Nasdaq 7th record high close in a row, certainly close to 20,000 now, the Nasdaq 100. The S&P topped 5,400, of course, and pretty close to 5,500 now. It's all because the US is potentially hitting this Goldilocks phase, really. The economy is still looking robust, while inflation seems to be heading south. It's really an ideal environment for stocks. The economy is strong enough to spur on companies, but weak enough to push the Fed towards rate cuts. That would reduce borrowing costs and then increase stock values. Going forward, I guess, a hardy economy should keep inflation simmering, but certainly a drop in inflation that could possibly signal a sort of faltering economy. And obviously, employment data will be key to that as well. What is clear certainly is that the tech and the Magnificent Seven, so that's excluding Tesla, which is no longer one of those Magnificent Seven, or no longer one of the biggest 7 stocks in the US by market cap, would continue to power ahead. If we just look at this chart, this is the Magnificent Seven relative to all the other 493 stocks on the S&P 500. We can obviously ChatGPT was really the key catalyst for this AI-driven move. And then obviously very recently we've had Apple's debut of Apple Intelligence, or I should say, and that briefly, the stock briefly overtook Microsoft as having the biggest market cap. So now the Magnificent Seven, they account for, well, only 1.4% of companies in the S&P, but over 32% of the entire market cap. So a third of the market cap, really. And that share has almost doubled since the start of the pandemic. Lower bond yields recently, of course, they've been helping. Plus, then it's just this AI-driven mania, really, which is pushing these handful of stocks higher and pushing up the broader index. But it is at the expense, we should say, of others. So I think the Magnificent Seven growth tops since 2000, 400%, whereas the equally weighted, say, Russell 2000, all of those companies with very smaller companies, that's gained only 17%. So just highlighting just this preponderance of the dominance of these big cap, mega cap 7 stocks. In here, it's just another chart just showing you the weight of the Magnificent Seven in, it's actually the MSCI, so all country world index now is greater than the combined weight of these markets: Japan, UK, Canada, France, and China. So interesting chart there. Okay, I just said we'd look at some of the indices, although they are fairly simplistic in looking at the uptrend, really. I think interesting sort of thinking that there's not a reason to sell, it's a reason to buy, which is interesting when we're at these lofty levels. And you can see we're just overbought on the daily RSI, on the weekly RSI, and if we stuck some Bollinger Bands or some Keltner channels on here, we would be overbought as well. If I use Keltner channels, really, and yeah, we're through the top of the upper band, although that doesn't mean we can't continue on an upward trend, of course, for some time. But yeah, just interestingly overbought. We probably want to get to 5,500 for sure, 20,000, no doubt. on the Nasdaq 100. And not much else to say. Interesting for the Dow, of course, that's been struggling. We had a sharp sell-off towards the end of May. We're just sort of tracking around the 50-day moving average now. That's a 38,823. I've got some fib levels in here, the halfway point of this sort of April-May move higher. That's a 38,848, and we're just below that now with that recent high then at 39,120. That's in the Dow. Interesting, I think the move yesterday was broader based, so value stocks and defensives, but yeah, certainly tech leading the way for sure. Okay, let's now go to last week's main event. So firstly, we had the US CPI data. Important to just review that for sure. And it came really after a string of far too high inflation prints at the start of the year. Markets really now, fortunately and pleasingly, seeing better readings with a second straight month of lower core CPI. The April core PCE deflator, that came in at 0.2, and the core CPI data for May, that repeated that fate, 0.2% versus 0.3 consensus. I've got it here. In fact, the core reading always more important, probably should put it on the bigger segment there, but also it's better to 3 decimal places, which is actually what's happening now. So 0.163% actually. That was the lowest reading, core month-on-month reading since August 2021. Same time headline, that came in at flat month-on-month versus 0.1 consensus, so below every single forecast. The year-on-year then, that slowed to 3.3 from 3.4 in a headline, and in the core slowed to 3.4 from 3.6%. But focus really on that month-on-month run rate, and the outcome really boosted the chances of a September start point for rate cuts quite considerably on the day. One other measure we should highlight was the super core measure. That's what the Fed look at for sure, i.e. that is core services less housing. That printed the first negative month-on-month reading since September 2021. Although I should caveat that with recent readings have been stronger than normal, so we really need a sort of series of those. But certainly this core month-on-month reading is getting a lot of airtime. We need to see a series below sort of 0.2% through a few months to then be sure that the inflation target, Fed's inflation target, is coming closer into view. And if we just got a few charts here, you can just see the blue bar, if you like, is the month-on-month reading. This is all for core readings, which is what is important to the Fed. Got the 3-month annualized, that's moving lower nicely, and then the year-on-year number obviously is moving down as well from those heights above 6%. Okay, moving on then to the dot plot. Well, the Fed actually, first of all, of course, which was just a few hours after that CPI data. So we had a big reaction to the dollar selling off and then bond yield selling off as well, as the September rate hike was seen more likely. The Fed, of course, they held rates steady at 5.25% to 5.5%. That's a 23-year high, widely expected. But then officials projected, and this was the kicker, only a single quarter point reduction for the year amid really rising estimates for what it will take to keep inflation in check. That markdown in the outlook for rate cuts from was from 3 25 basis point cuts seen in the Fed's March projections, and that was made despite the central bank's acknowledgement in its new policy statement of modest further progress towards its 2% target, which was an upgrade from the previous statement, and marginally more dovish. Otherwise, there were a few changes in the statement, but the biggest takeaway, of course, was this change in the dot plots. You can see it here. Markets and analysts really, they were looking for 2 rate cuts in 2024, and while one is now the median projection, it was a pretty close call between 1 or 2 in 2024. So as I've seen here, as I've say here, 4 officials had no cuts, 7 had 1 cut, 8 had 2 cuts, and the plurality of the dots was therefore in favor of reducing the policy rate by 50 basis points this year, and really a healthy majority saw at least 1 cut. We just cast our minds back to March, just to possibly take these with a pinch of salt. 2 members opted for no change this year, 2 for 1 cut, 5 for 2 cuts, 9 for 3 cuts, and 1 for 4 cuts, 100 basis points that is. Yes, moving on, 2025, that saw a median increase to 4 cuts from 3 previously. So median dot plot is 4.1 from 3.9 in March, while the 2026 dot plot the median dot plot remained unchanged at 3.1%. So the net impact to the next 18 months is a reduction of 1 less 25 basis point cut, which is, of course, this year. But note, actually, and you can see it on here, projected rates still are moving upward, and still there are a wide range of opinions. Coincided actually with an increase to 2.8% in the estimated long run, or that is basically a neutral rate of interest. That's the highest since 2019. It's up from 2.6% previously, and then 2.5% before that. Really indicates policymakers kind of concluded the economy needs more restraint in order to really finish this battle against rising prices. That said, over the long run, really 2.8% neutral Fed funds is perhaps too low, potentially in an environment where, well, you've got ongoing loose fiscal policy, irrespective really of who wins the November US presidential election. We also have demographic changes, of course, and then the ongoing sort of deglobalization trends as well. So just something to bear in mind on a sort of longer term basis. As for the press conference, Powell really, he added kind of not much new information. He preached really data dependence. Even as he welcomed the May inflation report, he said he would like to see more of that, repeating inflation is still too high and they need more data to gain confidence. Probably sounded a touch more dovish than the projection really implied, really. Policy definitely will be driven by data in the months ahead. He said also that projections aren't a plan and they can adjust with the Fed ready to respond either way. So really leaving his options wide open, and the Fed really will remain reactive with that. As I said, that off-stated need for greater confidence. Ultimately, if you think about it, policy is restrictive at 5.25% to 5.5%, especially when the neutral rate is around 2.8%. The Fed, of course, they don't want to cause a recession, and if data allows, then they will make policy less restrictive. Markets, interestingly, and you see this chart here, still see a rate cut in September. Futures giving it, I think, around a 60% chance or so, the last time I checked. And you can just see this difference here between the Fed before and after, and markets do expect more rate cuts in 2024 this year than officials, especially with that change in the dot plot. But all in all, it certainly means inflation data, so CPI data, of course, PCE data, which is certainly the Fed's favored inflation gauge, wages, other price measures, they will continue to be the most important information for gauging the future course of rates. And then obviously the dollar, as I've mentioned, 0.2% month-on-month core, that is key really. We also probably need to see some labor market slack, which means unemployment potentially going above 4%. As for that sort of PCE number, it is coming up in 10 days or so, end of the month, next Friday. Markets really looking for a flat reading pretty much in the deflator, and then sort of around the 0.1% number for core. That's the monthly number. That would be, well, very tolerable, of course, readings, and really, in fact, would continue the year-on-year tendency, interestingly, for Q2 actually to be higher, so Q3 numbers to be sort of more subdued than in the first quarter. Bottom line certainly is that they're helping the bond markets at least to feel more secure about the rate cutting that is potentially going to come in September. We've got the core PCE here, just showing you these numbers here against this sort of headline and core CPI data. So the PCE is the green number, and you can see it's lower. These are just the year-on-year numbers, but still just showing you that is what is the Fed's favored inflation gauge. And then here you've just got a sort of general idea on the labor market as well. CPI sticky was, but still just ticking lower in the last reading. Okay, we'll quickly move on to just the dollar chart, just to show you, first of all, where we are with that now. This is the DXY, which you can see here. And yeah, we're just tracking around the 50-day moving average, that blue line 105.20. You've got the fib line 105.25 as well. Recent high from last Friday, that's a 105.80. So yeah, just if we do lose that sort of 50-day moving average, then we're back down to potentially should extend this upward trend line, which is around, where are we? Probably around 105 or so. So there's a few markers, 105 support, 105.80 initially. If we do lose the 105, then we're down to potentially the black line. That's a 200-day moving average of 104.47. Also this week we did have the RBA meeting. If I just pull up the Aussie against the dollar, pretty sideways sort of range trading recently between 66 and 67 for the last few weeks at least. Interesting. Well, the RBA, they left policy unchanged as expected at 4.35%. It was actually one of the small meetings, if you like, so had no updated economic or rate forecasts. And really, yeah, RBA's communication remained mostly unchanged, but it did have a hawkish tilt. So they noted that since the last forecast update in early May, economic growth momentum appears to have cooled further. Unemployment rate has risen, wage growth slowed slightly more than expected, but underlying price pressures, this is the problem, they remain sticky, and really there is uncertainty over both domestic and overseas developments still remaining pretty high. The pace really of disinflation, that's been slower than previously anticipated, and really inflation still remains somewhere above the midpoint, remember, of the RBA's target range, which is 2 to 3%. So the April CPI indicator, that rose by 3.6%. That was up from 3.5% the month before, core by 4.1%. The May forecast actually assumed a return within the target in the second half of next year and to the midpoint in 2025. So really, you can understand that the RBA not ruling anything in or out in terms of policy rate outlook, but signals really no urgency in terms of cutting rates, while kind of reinforcing the need to be vigilant for upside risks to inflation. Chair Bullock, actually, during the press conference, she later revealed the board did discuss the case for a rate hike, and really sort of mildish but hawkish tweaks then to commentary, as has helped the Aussie dollar trade firmer in the last couple of days that you can see. So it pushed off the 50-day moving average, the blue line, at 65.86, but again we have resistance around 67 and just above there, potentially to look out for here. Interesting though, RBA, same with the RBNZ actually, that potentially they will be the most hawkish central banks, the most hawkish major central banks, which means potentially the Aussie does get or has some underpinning of support, underpinning of buying really going forward, especially if the Fed does then potentially succumb and cut rates in September. Okay, let's move on now to UK data, which was out today. First of all, the CPI data. It is a big week, of course. We get, well, we had the CPI data. We have the Bank of England tomorrow, retail sales on Friday, and of course, we have the ongoing general election in the UK. All means that the bank might, probably likely not to say too much or do too much. and especially as there are no quarterly forecasts or press conference at the Bank of England meeting tomorrow. All might come as a relief actually to policymakers, because they probably would like to see more time, have more time to assess the latest inflation picture. So CPI, the headline, well, it hit 2%, so that's the Bank of England's target. Of course, that's down from 2.3% and 3.2% prior, driven really by goods prices as lower energy prices gradually filter through the supply chain. So we had food, household goods, and clothing all now contributing a lot less to CPI than just even a few months ago. You can see it's the first time we've hit the target since spring 2021, so 3 years ago or so. Key number, well, key number is core. The core reading that did fall and hit estimates, 3.5% now, down from 3.9%, but still elevated really. And then the really key number, as we put here for the MPC, is services inflation, and that came in higher than expected for a second month in a row in May at 5.7%. Sorry, that should be changed really. It should be it came in at 5.7%. Oh yeah, in May from 5.9% in April. That is good. Sorry, the graphic is good at least. And that is potentially, yes, a worry for the MPC. Their forecast for this May, or from the May MPR, the Monetary Policy Report, was for service inflation to hit 5.3%. So yes, that is a worry, potentially still persistent and elevated, and will concern certainly the hawks on the MPC at the Bank of England. Just to have a chart here, just showing you just this disinflation process, of course, but still elevated. Well, this is just the core and the headline, but of course, services as well, still elevated with that core now 3.5%. If we move on now to the Bank of England preview, then, well, expectations are for the base rate to be kept at 5.25%. If we think about the prior meeting, Ramsden joined Dingra in calling for a 25 basis point cut. That's probably likely to happen again, so it'll be a 7-2 split. While the accompanying policy statement, well, it reiterated previously guidance that monetary policy needs to remain restrictive for sufficiently long. That'll be interesting whether there's any tweaks to that so that they line up an August rate cut or not. Of course, since that prior meeting, we talked about, well, we've already talked about headline inflation slipping, services being a disappointment, of course, and then in the labour market, well, the unemployment rate has nudged higher to 4.4%, although there is some data reliability issues there. And then earnings growth, that does still remain sticky at 5.9%. PMIs, and I've got one on here, the composite, well, that fell actually from 54.1 to 53.0, but interestingly, manufacturing rose above the sort of contractionary territory from 49.1 to 51.2 at the last reading, although services slipped slightly from 55.0 to 52.9. Should note that the rhetoric, well, since the prior meeting, really, that's been lacking, really, as the Bank of England have said they will not comment on monetary policy in the build-up to the July 4th election. Interestingly, I guess in the aftermath of last month's decision, we had Chief Economist Pill really say that it's not unreasonable to believe that over the summer the Bank of England will have enough confidence to consider rate cuts, adding that they could cut and then still keep monetary policy restrictive. Overall then, probably likely not to do anything. Even some tweaks will be interesting because of this high service inflation number. Yeah, any tweaks to existing guidance will be key, as I've put on this graphic, though possibly, yeah, they won't have too much confidence just yet. In terms of pricing, there's now, after the CPI data, actually, there's, well, I put in here, total of around, I'm just checking, around 44 basis points, I think now, just checking where we are, in total of rate cuts by the Bank of England in the UK this year. That's sort of changed from 48 basis points or so after the CPI data this morning. Sorry, I'm just checking what the pricing is after that data now. Chances of an August cut, they've reduced actually now from above 40% to below 40%, I think. And the chances of a September rate cut around sort of 80% plus. So that's nailed on. It's just whether this sort of 40% level, 40% level ticks up or so if we do get another soft inflation print, which is due before the August meeting. It's interesting that sort of Bank of England have recently, when we've heard from them, been relatively confident with their predictions. So that does keep the hopes of a summer rate cut alive potentially, and that could be underpriced then, that sort of 30-40% chances of by market. It's currently potentially. For sterling, interesting, I think sort of soft data, dovish soundbites post the election may possibly only have a limited impact if expectations for a September cut by the Fed, remember, also grow. If we just pull up a cable chart first of all. Yes, and really as well, if you think about it, if investors view possibly an early Bank of England cut as simply bringing forward the timing of one and really not a shift to a more aggressive easing path, then potentially that will keep buyers active in sterling. As for the cable chart, you can see 128 really has been a sort of barrier resistance really, and above there to more sustained upside. That recent high is at 128.60, which is the year-to-date high actually. No, it's not. Sorry, the year-to-date high is at 128.93, so 128.60, that recent high. If we do lose probably this support around here, which is around 126.60 or so, then potentially we'll roll over back down to, well, you've got the 50-day moving average at 126.17, 200-day at 125.50, not massive relevance. Possibly in the 200-day you can see just acting as support, but not more recently. So yeah, support around 126.56, 126.58, and then obviously 128 and above is has proven tricky so far recently. I said we'd touch on the S&B actually, just briefly, which is interesting simply because if you look at dollar Swiss, it broke down through its 200-day moving average there, the black line, and a big fib level, 88.86 as well. Which is a long-term fib level of this year's move really. So 88.86 plus the 200-day moving average at 88.95. That's acted as support previously, you can see, and then we just broke down yesterday. So an interesting place for dollar Swiss as we come into the S&B. Obviously, we've had a lot of focus on Europe and the political chaos potentially in France, with then the snap elections called for the 30th of June and then July the 7th. Well, Euro-Swiss has been the sort of focal point for Eurozone stress, but then obviously I've just pointed out dollar Swiss as well. Had a big move down in Euro-Swiss, 4% or so in a couple of weeks. And it's interesting that it's come on the back of, yes, this S&B meeting we have tomorrow. We were sort of 50-50 for another cut, but now that's swung in favor really around 70% or so and higher of a rate cut by the S&B tomorrow. Assumption really is that the S&B needs to follow through or else, well, Euro Swiss could fall even more sharply. I think that kind of makes sense, but some then argue that the S&B will not want to send a signal with back-to-back rate cuts, that it's content really with its inflation profile, and that's really remembering speeches by S&B Chair Jordan about the potential upside risks to inflation going forward. So interesting point for dollar Swiss and also euro Swiss. If I just pull up that chart, which is here, and you can just see this strong fall over 4% through the 200-day moving average, and then another fib level here, but we are oversold. Okay, finally, I'll just wrap up with a look at the, well, we have actually PMI data, another upbeat set of surveys for June could bolster the, well, euro, the single currency, as a strengthening economic recovery would dash expectations of another rate cut by the ECB in the near term. Investors will also be watching quarterly. Well, we had the quarterly wage data, which was still fairly punchy on Monday. And yeah, in focus will be the PMI data. I just have a graphic actually that I just should show you, which is a nice one here. And it just shows you, it's not updated, but it just shows you the path of some of the different global economies, and you can just see Europe in the blue, which means below 50. Sub 50 is in contraction territory, whereas the sort of hotter, redder squares are above 50, so in expansion mode. So you can just see them sort of getting slightly less dark, which is positive potentially, as they get towards that 50 boom bust sort of level. So that will be the PMI data. If I just then pull up euro dollar actually, which we haven't looked at, which is here. You can see we just fell down quite sharply below the 50-day and 200-day moving average. We dropped to below 107, 106.67 the low, but we just pulled back a few days of buying now as this stress in the Eurozone, political stress really, is slightly abating, with Marine Le Pen kind of saying that she will toe the line slightly, but still uncertainty to watch in the build up to those elections and potentially afterwards as well. So we've got a fib line at 107.28, and then that recent low, as I say, 106.67. Otherwise, upside initial resistance potentially 107.67, and then fib level next at around 108 level in euro dollar. Finally, I've said we will look at Japan CPI data. If you cast your mind back, Bank of Japan, they decided last week to delay any decision on tapering its bond purchases until the July meeting. That was a bit of a disappointment for markets. Cautious stance, really that pulled the yen lower, dollar yen higher, but possibly there may be some good news for the yen from the CPI report out Friday. Core is expected to rise back up to 2.6% in May from 2.2%, potentially then adding to the case for the BoJ to further wind down its stimulus policies. Tokyo CPI, which is really a precursor to the national data, that printed at, well, rose to 2.2% from 1.8% previously, was in line with the market consensus, and then core, that increased as well, in line with market expectations at 1.9% versus 1.6% previously. Utility prices, they've been a significant factor in the increase. They rose 4.7% in May, compared to a decrease of 3% in April. And then goods prices, they've also seen a moderate rise in their prices. That contrasts with prices in the service sector, which saw moderated growth. So given that Tokyo inflation trends often precede national results, then consumer prices expected to increase to nearly 3% year on year in the coming months from 2.5% in April. And also then the weak yen, of course, and anticipated large wage increases, they're expected to potentially further intensify inflationary pressures in Japan. As for dollar yen, you can see we're just edging towards sort of intervention levels, really, towards 158 and above. Of course, that spike high was at 160.20. That sparked, I think, 62 billion dollars even of intervention. So we dropped sharply, and it sort of did introduce some two-way risk, which was probably the goal by the Japanese authorities, but now we're just edging higher, of course, even interestingly as yields, treasury yields have gone lower. So just watch out for verbal intervention. Of course, we heard from Governor Ueda a few days ago, just priming markets potentially for a rate cut, a rate hike by the Bank of Japan in the next couple of months, possibly in July. But yes, interestingly, they did intervene potentially. Does that mean, like in previous intervention periods, that authorities hope or think that treasury yields will come down, which means the Fed will cut rates, which means then potentially dollar yen goes lower? We shall see. Okay, I will wrap it up there. Great to have you on the call, as always. Really appreciate your time. A fair bit to look forward to, even with the Bank of England and the S&P, and then the PMIs this week at least. Take care out there, and we shall speak to you in a few weeks' time.